Well, jumping into the macroeconomic update, we of course have to start with yesterday's news from the Federal Reserve that after a pause in the interest rate hikes in June and July came with another 25 basis points increase in the federal funds rate. So that takes the target rate to a range of 5.25% to 5.5%, which is the highest rate that it's been at since early 2001. Now, the initial communications from the Fed indicated that another increase at its following meeting in September is certainly likely. However, the FOMC has continued to telegraph that they're very dependent on data. They'll be closely tracking all those indicators as they come out. So we also will take a look at the intervening economic data over the next month and a half to see what the forward progress will be on that. Regardless, it looks like rates will remain elevated through 2023 for sure, and likely into 2024 as well. Moody's Analytics forecasts the first rate cuts in mid-2024. But again, all of that is really dependent on data between now and in the next year or two. This chart on the right here shows, just to help contextualize, the pace of the current interest rate hiking cycle. So this shows the hiking cycles of 6 months or longer over the last several decades. And it really puts into context how aggressive the current cycle has been, with the exception, of course, of the anomalously high interest rate hiking cycle of 1980 to 81. The current cycle is really one of the most aggressive that we've seen. So certainly higher than the most recent hiking cycle in the mid-2000s and higher than the mid-1990s as well. So these interest rates, of course, have fed through to the rest of the economy, including to the mortgage market. So 30-year mortgage rates have been hovering around the 6.8 to 6.9% range in July so far, which is obviously a lot higher than we've gotten used to over the past decade or decade and a half. It's just below the peak that mortgage rates hit in late 2020 when they broke 7%, as reported by Freddie Mac. So obviously high mortgage rates, which will have some effects on the housing sector that Carl will jump into a little bit later. 10-year yields have also risen, but not quite by the same magnitude. So as a consequence, the spread between the 30-year mortgage rates and 10-year US Treasuries has widened to a historic high of over 300 basis points, which is even higher than it got to up during the GFC. So some economists think that will put some pressure on mortgage rates to moderate over the coming months, but that remains to be seen. Turning to inflation, we've had some good news over the last month. The all items CPI index fell to 3.1% in June, which is the lowest rate it's been at since March of 2021. A lot of that's been driven by energy prices, which are down over 16% year over year. Now, stripping out energy and food prices, which tend to be more volatile, looking just at core inflation was also down, but remained slightly more elevated at 4.9% on a year over year basis. However, the monthly increase in June was just 0.2%, which is the lowest monthly core CPI increase that we've seen since February 2021. So certainly welcome news for the Fed, but they have indicated that, well, they're excited to see this. They obviously want to see several more months of lower inflation readings rather than get too excited and ease up on their interest rate increases based on 1 or 2 months. Now, over the last 3 months, headline inflation has risen at a slightly more modest pace even. Headline inflation is up 2.7% on an annualized basis over the last 3 months, while core inflation is up 4.1%. So over the last 3 months, slightly slower pace than the annual growth rate. Those two rates are converging, the 3-month and the 1 year, largely because some of those baseline effects are starting to fall out of the annual calculation. So we'll see that continue to happen. So inflation's on the right trajectory, coming down, but still remains higher than the Fed wants to see it. A twin theme that we saw in 2021, along with inflation, was construction cost increases. So over the year of 2021, construction costs shot up 35%, really a sharp rise. In 2022, that trend reversed some and prices came down, ended the year 2.6% down. Since then, 2023, we've seen some return to construction cost increases. Prices are up about 3.5% year to date, but they are still down 3.4% year over year. So we're starting to see construction costs go up, but nothing like the dramatic run up that we saw a couple of years ago in 2021. So overall, producer prices, all commodities, were flat in June, but down substantially year over year. So down 9.5%, which really is good news and just further testament to the fact that inflation's broadly cooling, although remains slightly higher still in the consumer space. So finally, I'm turning to today's big news of the GDP report. It looks like we are not yet in the much awaited recession, as Q2 GDP grew at 2.4%. A lot of that was supported by consumer spending and business investment, which were both up. Residential fixed investments were down, which we might be able to talk more about when we move on to the housing sector. But 2.4% growth is roughly in line with historical trends, slightly stronger than Q1's 2% growth. Nevertheless, recession risks do remain in the headlines and in the downside risks to the macroeconomic outlook. Expectations have moderated somewhat over the summer, but certainly remain high. So the Wall Street Journal surveys recession probability for the next 12 months has fallen to 54%. So again, still elevated, but slightly below the over 60% readings that we've seen since October in that report. There's obviously a fair amount of spread in outlook on recession probability. Deutsche Bank recently doubled down on its call that a recession will hit by the end of 2023. And on the other side, Goldman Sachs just decreased its recession probability from 25% down to 20%. So they're one of the lowest forecasts out there. Consensus comes in right about 50 to 60%, which is where our own sentiment survey that RCLCO published and that we discussed last month, that comes in right at around consensus as well, at a 47% chance of recession in the next 12 months.